What's up, everyone? Dylan here. I wanted to hop on for another episode of the weekly analysis video. There's a lot to talk about. I apologize for the lack of content. I was sick for like 2 weeks, and then I got busy with my full-time gig, right, working at the prop firm. This is kind of like my little side hobby. So sometimes I kind of get busy with other things where I lack some content here, but going forward, I'll try my best to put out some more consistent stuff. Okay. So what has happened, right? A lot has happened. We have dropped as much as 10% in the S&P and as much as, 17% in the NASDAQ from all-time highs to recent lows. Okay. In the beginning of this video, I'm going to be talking about some of the fundamental stuff, what's been happening to cause this aggressive sell-off. Going forward, I'm going to try my best to outline very, very specific levels to look out for going forward to kind of give you guys an idea of how to read relative strength and weakness and ultimately try to guess where the market goes in the near future. Okay, so what has happened? Okay, a few different things. I'm going to try my best to keep this PG rated so that, anyone who is new to this type of information can easily understand it. Okay, so last week there was a few different economic prints that showed to slowing growth in the U.S. economy. Okay, you had ISM manufacturing PMI, you had jobless claims, you had the jobs report. I'm looking over here because I have some notes written down, okay? This is from Tom Essay. I thought this was a pretty good write-up, so I'm going to quote him, okay? He said, there has been a lot of complacency. What do I mean by that, right? A lot of people just assumed that the market was going to keep going up as it has, right? It was going up despite having, fears of recession and high interest rates, right? Higher for longer interest rates. The Fed hasn't cut anything, right? Yet the market continued to go higher. There has been geopolitical risk over the last several months as well, if not more, right? The market continued to go higher and higher. So there was complacency, okay? On top of the complacency, there was very, very, very rich valuations, okay? In fact, 2 weeks ago, the S&P was trading near 5,600, which on a 2024 EPS, that was 245-ish, right? That is a 22.8x multiple. What the heck is this guy saying? Basically, what that means is there was very, very high valuations, and it was leaving very, very, very little room for margin. So any type of economic slow in the data prints could set up for large drops, okay? And that's exactly what had occurred, okay? So those multiples are for perfect environments, right? For example, solid growth, explosive earnings growth, right? No existential risks such as geopolitics and so on and so forth, right? You have, politic and geopolitic risks now as well. So like I said, very, very, very small room for error. So once those different economic prints came out that were showing signs of slowing growth, excuse my language, right? It started to come off aggressively. So this is what Tom wrote as well. Okay, he said, that's not the environment the market has been in for months, and last week the data was bad enough to make the market finally admit it, and that's why stocks dropped hard. Not because the actual fundamentals turned materially worse, they just weren't as good as hoped for, and investors finally had to admit that. Okay, so on top of that, what made it more aggressive, the sell-off, was the unwinding of the yen carry trade, right? Hopefully, you guys don't get confused here. I'm going to try my best. I have a few notes, right? What is the yen carry trade, right? What that means is essentially you sell short, you short sell Japanese government bonds, right? And you take the proceeds and use them to buy risk assets, right? anything from US stocks to emerging market debt to commodities to crypto, even US corporate and government bonds, right? This trade has been utilized for more than 2 decades thanks mostly to the fact that the Bank of Japan keeps interest rates artificially low. Okay, so the spread between Bank of Japan rates and, say, the United States rates has been very, very large, right? The spread between the rates have been very, very large. So what people have been doing, right, and I'm not talking retail, it's even, there was rumors that Warren Buffett was doing this trade for years as well. So we're talking very, very large, institutional folks that have deep pockets, right? They were selling short Japanese government bonds, right? Borrowing money at a very, very low rate, and they were then taking that leverage money and buying other things, right? Even US yields, right? Rates have been very, very high. You could put that money in freaking cash markets and get a 5% APY on 1% leverage borrowed funds, right? That's a 4% net profit. You pocket the difference, okay? What happened was the Bank of Japan raised rates, okay? And basically what that did is that leveraged borrowed money got more expensive to finance, okay? So a lot of people got scared thinking that it was going to be a domino effect and that the BOJ was going to continue raising rates, that they had to sell any money or, a chunk of their, risk assets, right? Whether that meant US stocks, crypto, so on and so forth. They had to sell those holdings to then finance their debt, right? At higher costs, okay? So that exaggerated the slow growth data that we got last week, okay? So those two pieces combined to cause those large drops. Hopefully that makes sense. I don't want to go further into it. I'm going to get to the point, okay? So what do we do from here, okay? What do we look at, Dylan? Okay, so that's what I'm going to do. So FXY, let's start with that because we just talked about the yen. This is a very, very good picture of what the yen is, right? What the yen is doing. Obviously, you could see that the yen absolutely skyrocketed on that move from the BOJ, right? Raising rates for the first time in years, okay? So the yen ultimately moved 13.5% higher, which is very, very large, okay? So going forward, we want to keep an eye on this because the higher it goes, the more pressure it's likely going to put on US equities and crypto, right? As we've seen over the last couple weeks, okay? So what I would do is I would look at the 200-day, which just so happens to line up with the 50% fib. Okay, you could see both those pieces of context are very, very close, okay? The purple line and the black line, okay? So if and when price gets down there, you do not want it to bounce, okay? Unless you're a bear, unless you're short selling the market, right? So as long as this thing stays above that 61-ish area, which is the 200-day moving average and the 50% fib, it's likely going to still remain a headwind for different risk assets such as the S&P, the NASDAQ, cryptocurrencies, so on and so forth, okay? If this thing gets below 61, it's likely going to take a lot of pressure off of the geopolitics and, basically that global risk aspect, okay? That's the first thing. Going forward beyond that, we also have some nice technical analysis on the S&P, the NASDAQ, and so on and so forth. So let's go over those things right now, okay? So one thing are gap fills. Gap fills have been working nearly flawless lately, especially on the S&P 500, okay? Going back to this one here, we have this gap fill on the S&P futures from Tuesday, July 23rd into the night of Tuesday, July 23rd, right? On the 6 p.m. Eastern time reopen, it had gap down, okay? So what we do is we mark that gap. You can either go from the low or the close of that candle, right? Whatever floats your boat, whatever you got to do, it doesn't matter. It does the same thing in my opinion, right? going forward, look how well it respected when it hit that gap fill, right? Once that gap was filled, sellers stepped in and ultimately, made the market drop 470 handles, which is 8.5% on the S&P. Okay, so that gap fill worked very, very, very well. Okay, going forward, I highlighted this yesterday at 12:03 p.m. right during the the afternoon or the midday, right? ES next upside area is the weekend gap fill at 5357, right? I highlighted what that looked like and where it came from. So let's go ahead and mark that one, right? I'll go to a smaller time frame, let's just say 30-minute, right? Same deal. This gap fill was over the weekend. So it went from Friday, August 2nd, and then it reopened on Sunday, August 4th at 6 p.m. Eastern time, and it had resulted in a gap. So that gap was unfilled up until today, and look where price went up to. Look at that right there. If we zoom in a little bit more, you could see price came right up to that gap, filled it, and that's exactly where sellers stepped in. Okay, no coincidence, right? It happened a few weeks ago, or not even a few weeks ago. What is that, a week and a half ago? And it worked perfectly, and that's why I believe that it was going to work very well again, especially when we're in this type of environment with high volatility. Okay, so I actually got short there. I shorted S&P at 5339.26 average cost, call it 5339.25. Why did I get in there? I was using yesterday's high as kind of like a reference point that if price defended or rejected at that gap fill, 53.57, and then got back below 53.42, which was yesterday's highs, I was going to get short with a stop loss above today's high, right? Essentially risking, say, 15 handles, right? Maybe a little bit more than that, or risking, 18 points to make, 50 plus, 100 plus, whatever, the case may be. But it was good risk reward. Okay, so that's exactly what I did. Okay, so very, very important to look at those areas going forward. And I do have to say that once a gap gets filled, it's no longer as important or nowhere near as important as it was. So now that we filled both gaps on the upside, it's still important to watch that 53-57 area. But going forward, if any gaps do occur, in the near term future, definitely mark those and view it as an area of support and resistance, relative to where price is. Okay, so that's that. That worked very, very, very well as noted. Not only was it a gap fill, but we also had 50% fib. Okay, we had 50% fib on the S&P, right? It got right up there. And then the NASDAQ also had a 50% fib level as well. Okay, you could see we'll go from the recent high to the recent low, and you could see sellers stepped in right at that 50% retracement, right? Which also tends to, act as support and resistance, okay? So you could see not only did it fill that gap, but it also lined up with that 50% retracement, which worked very, very, very well, okay? Not only was that the case, but US 500, which is the cash index, it's the CFD for the S&P 500, it came up to the 100-day moving average, okay? And very, very important to note that this 100-day moving average was previous support, okay? It was previous support back in mid-April, okay? So once we got below there, look where we have been rejecting, right at that 100-day moving average. Previous support then turned into resistance, okay? So going forward, if you are a bull in this market, you want to see US 500 not only get above that 100-day moving average, but also close a daily candle above it, okay? That's very, very important for bulls going forward. Whether that happens tomorrow, next week, next month, who knows, but that is going to be a very, very important piece of context for the bulls. If that happens, I would assume that that trend is going to continue higher, okay? But as long as we continue to reject that 100-day moving average, right, on the daily chart of US 500, I would like to imagine that every single pop is going to continue getting sold near that, okay? So that's very, very important as well, okay? So those are my upside areas, okay? The 100-day moving average and the fibs, okay? Going forward, what are some downside areas? To start off, the NASDAQ has a very, very important one that has proven to be key support. Not only did it bounce there Friday, April 19th, it also bounced there not once, but twice on Monday, August 5th, right? If we go to a 30-minute chart, you could see it double bottom there nearly perfectly, right? So that level on the NASDAQ futures is 17,373, okay? So like I said, it double bottom there on August 5th, and it also happened to be the low on August 19th. So clearly, bulls are trying their best to defend there, and they have been doing so very, very well. So going forward, if that breaches, the next level down would be S&P with that same exact reference point. Okay, going back to that mid-April low. Okay, so going forward, right, if the NASDAQ happens to break that August or April 19th low that we just looked at, I would assume that the next level down would be S&P testing this 5,028 level, which is the same reference area support as the NASDAQ, okay? Very, very important, okay? And then one more thing that's very, very important as well, and if you're in the Discord, you'll know that I talk about this all the time. It is the VIX, okay? The VIX, ideally, right, basically, if you're a bear, you want it to break above 26.4, which is the previous swing high from yesterday, right, late in the day, yesterday, Tuesday, August 6th. If that breaks above 26.4, it will naturally put more pressure on the S&P, which will ultimately probably lead to more downside weakness, okay, in the S&P. If it fails to break above 26.4 and hold, and it starts to roll over back to the downside, I would imagine that S&P will ultimately hold this low or bounce before getting to that low and continue to the upside, okay? So hopefully this video was helpful. Hopefully it was easy to understand. Hopefully it was very clear, concise, the whole nine. If you guys like it, give it a thumbs up. If you have any questions, hit me up in the comments. And like I said, I apologize for the lack of content, but going forward, I will try my best to, keep posting. So peace.